And I'll go ahead and introduce our presenters today. So today they are presenting on COVID, impact on insurance, what happened, has it recovered, or is it a long hauler? Our panelists today are Paul Oostenbrug. He's an expert in Medicare insurance products. He also helps younger people with marketplace insurance options and helps them plan for when they need to use of long-term care services later in life. Then we also have John Rossetti, and I apologize if I got that incorrect, and Ed Risley with Daniels Insurance. John is an employee benefits practice leader. He has over 40 years of employee benefit experience with a concentration in health insurance. Our very own Ed provides insurance and risk management options to his clients. I'll go ahead and turn it over to our panelists.
I'm happy to get going, but could you make me host or co-host so that I can actually show stuff when it comes to that time? Thanks. Okay. I'm going to set the stage with some impacts, and then John and Ed are going to talk in much more detail about those, and I'm going to attempt to be their slideshow runner. So we will see how this goes. COVID had a series. So I'm sorry if I'm echoing. If you're not speaking, could you perhaps mute yourself? Thanks.
Yeah, and Paul, sorry to interrupt. I forgot to mention everyone on the meeting, if you could put your name and just contact info, email, phone number, whatever you prefer, into the chat, just so we can keep a record of who was all in attendance today. Thank you. Sorry, Paul.
That's quite all right. Thank you, Keith. So I'm going to try to set the stage. There's a lot of components to the insurance world, as John and Ed and you probably know. I'm going to sort of highlight some trends that were observed in several of those, and then away we'll go. So what happened when there was COVID? There was a lockdown. What happened to people using their cars? They stopped driving. So on the auto insurance side of things, the claim frequency plummeted. Those open roads, however, apparently encouraged many people to drive faster and less carefully, so claim severity increased. Other lines of coverage experienced drastic reductions in premium as a result of lockdowns. Workers' compensation, travel, event cancellation, and trade credit were among the lines hardest hit. And while reduced claims helped offset the impact of reduced premium in some lines, like workers' comp, other lines suffered the double whammy of reduced premiums and increased claims. How did clients behave? Well, dog ownership spiked, and this is a theme that we'll be touching on during the course of the presentation. But that could provide growth opportunities for pet insurance, this observer thought, but no data yet on whether that's actually turned out to be the case. Life insurance companies, no surprise, have experienced an increase in claims due to excess deaths affiliated with COVID. Long-term care and disability carriers were impacted significantly. Long-term care insurance companies experienced reduced claims, again, increased deaths, which meant that people were dying before they could claim the long-term care benefits, and a higher rate of terminations because people couldn't afford the coverage any longer. Disability insurers experienced rising COVID-related claims, which were offset by decreased claims from injuries and surgeries provided as policyholders stayed at home and canceled medical appointments. How did insurance companies adapt? As personal interaction was cut off, as we all know all too well, insurance providers scrambled to retain business and expand their market share through virtual communications, virtual visits, and on the claims side, some carriers experienced similar obstacles. As you would imagine, on-site accident investigations, independent medical exams, home inspections, and in-person interviews became difficult, if not impossible. So this had a series of ripple effects, not the least of which was on underwriting. Long-term care insurance carriers, for instance, stopped writing new policies or reduced their maximum issue age from 80 in some cases down to 65. Health insurers issued premium rebates in some cases. Those insurers had to find new ways to spend money on healthcare and services. United Healthcare sent me a nice Fitbit because it was something that counted towards the medical loss ratio. Thank you, United Healthcare. So the conclusion is that the pandemic forced the industry to re-examine its role in future pandemics, rather than this one, which started off as a black swan event. This won't happen again for another 100 years. I don't think any of us believe this is not going to repeat itself in some way, maybe very different implications at the time, more quickly than 100 years down the road. So with that, I'm going to turn it over to John and Ed.
John, take it away, and I'll follow you. So,
Okay, great. So
here, I'll give you the screen.
I really don't have much to say. I'll touch upon a little bit of what Paul has to say regarding the health insurance industry and what impact COVID had on it. Obviously, one of the major events that took place as a result of COVID that had a huge impact on the health insurance industry specifically was the loss of coverage. So many people lost their jobs due to loss of hours, which put them either ineligible for insurance or in a situation where they couldn't afford the insurance any longer. So that resulted, however, in a large number of people looking for alternatives to their coverage. And one of the alternatives that was impacted was Medicaid. So many people, because of their income now has changed dramatically, became eligible for Medicaid. So the health insurance, or actually not the health insurance system, but the delivery system, the medical system actually benefited from folks getting coverage through Medicaid because they could at least get some reimbursement for the services that they were provided. But now, based on this large number of uninsureds and newly eligible people for Medicaid and people scrambling to get coverage under their spouse's plan if they could. But all of this resulted in what we know as the American Rescue Plan. And the American Rescue Plan, provided a lot of things like payroll protection, but it also created a COBRA subsidy. So this is going back to one of the things Paul touched upon, which was strategies that tried to maintain coverage for those folks who lost their jobs. So the premium subsidy under the American Rescue Plan is a 6-month program that started in April 1st, and it ends on September 30th. A lot of folks were able to maintain their coverage because if they're eligible for COBRA beginning April 1st and through September 30th, if they're still eligible, they're getting that coverage at 100% subsidy. It's actually 100% employer paid for their COBRA coverage. The employer will recoup that money through a premium credit, and it's unfortunately going to be a sort of a long and bureaucratic process for employers, but it's a way that the government stepped in and try to help the insurance companies maintain some membership. And the reason why that's important, regardless of the fact that so many insurers actually received record revenue during the pandemic, the rebates that Paul talked about could have a devastating effect on reserves for health insurance carriers. So they are scrambling to do things like give out Fitbits and spend money on costs that will qualify as medical spend to reduce the amount of rebate they have to give to their members if they don't spend 80% of their revenue on medical claims. So so that's just putting a significant strain on the insurance industry. The fact that there were not that many claims so significantly reduced utilization of medical expense during the pandemic has also resulted in panic because we don't have any idea what the utilization is going to be for this year. However, what we've seen thus far, since we have again another surge, and we have those folks who are considered long haulers or people who are still suffering from the effects of COVID, even though they're not positive for COVID, they're still experiencing significant medical issues. And that's putting a strain on the delivery systems. And because of that strain on the delivery systems, a lot of folks who put off services last year can't get access to care because of the strain on the delivery system. So we may see yet again another year where the insurance companies see reduced utilization and thus, reduced medical expense, and they could see record profits again. It's kind of an interesting situation that has been created, and it's unprecedented. And insurance companies are having difficulty in trying to predict what their premiums should be for 2022 and 2023 because of the uncertainty of what's happening right now. So those are just some of the issues that are really affecting what's going on in the health insurance issue right now. And the long haulers are just they're not putting a lot of financial pressure on the health insurance industry, but they're just creating a flood of utilization in the delivery system. They just can't seem to have enough access to cover all of the folks that need medical care at this point in time. So they're putting a strain on the delivery system, not so much on the health insurance side. But so it's going to be an interesting outcome when all is said and done. So Ed is going to take it away and talk about risk and what's happening in that part of the world.
All right. Hello again. Thanks, John. That's great. So I'm going to address kind of the property casualty side of things and how COVID has impacted that section of the industry. Obviously, there's no surprise that the pandemic's had a huge impact on businesses around the country and the world. And so what's interesting is, of course, when businesses began shutting down, losing employees, states were closing, they began to look for relief in terms. And so one of the first places they looked were their insurance policies. Then they began finding that maybe those policies didn't provide the coverage that they thought should be there. So then they went to their next place to turn for help, and that was, of course, the legal system and attorneys. Attorneys are just having a great time. And with that, I would ask Paul. I have got a short, brief video that kind of describes the society and legal systems approach in pushing back against these insurance companies and the fact that there may not be business interruption coverage in those policies due to COVID. So if you could run that video, Paul, that would be terrific. This video was played in Times Square by a group of attorneys that put together, I think it was called Business Income Group, and then spread throughout the country. But it expresses their sentiment pretty well.
frightened, they're concerned, and this is what the insurance companies can be now. They can be the manufacturers that help win the war in today's war, which is COVID. They promised us that they'd be on our
Hey,
side.
Paul, the
That we'd
audio
be
is
in good
kind of off
hands.
on the
We
video.
really need to make insurance great.
That is a little fuzzy.
The audio wasn't working. I clicked share sound and optimized. You couldn't see
Yeah.
any of it?
You could hear it. It was just kind of breaking up and maybe a little bit. Maybe need to just turn the volume down on the player a little bit.
Yeah, this is all on my laptop. I'm gonna go to the next room and sit next to the
No.
router. Maybe
And-
it will work.
And the other thing is, don't do the optimize.
Okay, I won't do that. So we're gonna try that again. Thank you for that suggestion, Craig.
I've been told that messes it up.
Wrong share.
Another example of COVID's impact on technology and Zoom meetings.
Well, phooey.
It's a challenge, isn't it? I'm glad you're doing that, Paul. I appreciate it.
Well, I'm doing what I'm doing. Here we are. Is that better?
People are frightened, they're concerned, and
Paul,
No,
try
No.
maybe turning down the volume a little bit on the YouTube player. See if that helps.
okay. No, it's probably too much. Trying again. Is that better?
people are frightened,
No,
they're
try
concerned, and this is
try maybe the volume on your computer this time.
Okay. Okay, we'll try that again. How about that?
people are frightened, they're concerned, and this is what the insurance companies can be now. They can be the manufacturers that help win the war in today's war, which is COVID. They promised us that they'd be on our side, that we'd be in good hands. We really need to make insurance great again. They need to be the good neighbor that they promised to be.
Restaurants are the life of the city. They bring communities together.
Don't abandon the artists who perform for you every day.
The restaurant is my home, my family, my life.
If you're not there for us now, then when will you be?
If the insurers abandon my theater, our production can start.
Insurance companies and the federal government need to do the right thing now. Times Square
Sorry, Paul, the
represents the energy,
audio is still pretty
entrepreneurialism,
staticky.
and creative
I think
energy of
Fiona
small business
suggested
people
maybe trying to
for the
play
entire
with no sound,
This demonstrates
I'm sorry, Fiona suggested what?
playing it with no sound.
It's almost done. I can play it
Yeah.
with no sound.
Right thing.
Well,
Well,
that,
for that, Paul, sorry for the poor audio quality, but I think you still probably saw that the message came through loud and clear. Insurance companies do the right thing now. And of course, that was a large legal group that was putting that on in Times Square. Sure, it wasn't inexpensive, but the crux of the issue all in that area relates to business interruption coverage, which is a portion of property coverage. And what they're indicating or alleging is that insurance companies are not doing the right thing by not paying business interruption claims, paying businesses for loss of income due to COVID. If you actually, so that's the one side of the argument, and probably one of the biggest in COVID. The insurance company or industry had an interesting response. Their response to that message of doing the right thing is, well, we are doing the right thing. We never intended to cover a pandemic in our policies. There are exclusions in the policies. What triggers coverage is a direct physical loss to covered property for policies that actually do contain business interruption coverage. And not all policies even have business interruption coverage. So the insurance industry came up with 4 basic points in answer to that video and the outrage of business owners. And their 4 points basically include: 1, global pandemics are uninsurable, and only the government really has the ability to pay such large amount of claims. And most policies don't cover pandemics. Second point is retroactive payouts for this coverage, which the policies never really were intended to cover, would cripple the insurance industry and put many carriers out of business. Thirdly, they said insurance companies are already paying readily claims that are covered under the policies that are arising from COVID. And lastly, they said most policies do contain a virus and bacteria exclusion, and those are all accurate. So again, the battle is over direct physical loss. What is exactly direct physical loss, and does that actually trigger a claim? The courts are where that argument is being decided right now. And currently, there's probably over 1,700 lawsuits around the country that have been filed to try to answer this question. And of course, hundreds of billions of dollars are going to be dependent upon how these courts respond and answer that. So what's interesting too, these lawsuits aren't just occurring in the US, they're occurring around the world. And there's similar arguments, and we're seeing similar results from the courts. It's going to, obviously, most of these lawsuits haven't been settled yet, but the ones that have been, what we're seeing is that state courts in the US are much more likely to rule in favor of the business owner and insured. Federal courts are much more likely to rule in favor of the insurance companies. Of course, insurance is governed on a state-by-state basis. However, what's interesting is when we're talking about how much money are we talking about here? The American Property Casualty Association did a study, and they determined that during the height of the pandemic, businesses in the US were losing, just from a loss of income standpoint, approximately anywhere between $255 billion and $431 billion a month during the height of the pandemic. Meanwhile, insurance carriers were receiving, just for property insurance premiums per month, $6 billion. So you can see there's a little bit of an imbalance. If the insurance industry as a whole is taking in $6 billion and they're being asked to pay out anywhere from $300 to $400 billion per month, they're going to be, that's not going to bode well for their financial bottom lines. So far,
do you want me to start sharing slides? I am not doing that. Are you talking to the slides or not yet?
Well, I'm following the orders of the slides. So
given how much work Priscilla put into that slideshow.
Yeah, they were just, so I am following the bullet points. If you want to share those, that would be fine, Paul. I'm just under the property section of those slides right now. And what the insurance industry has done in terms of currently paid claims that are not excluded, they're already in the US at about $38 billion. So it's not like the insurance carriers are not paying claims, they're just paying covered claims. Right now, Lloyd's is the carrier that's bearing the biggest brunt of that. They're up to about 5 billion themselves, and then other carriers have obviously less amounts. But it's going to be, of course, decades before we figure out what the total cost of the pandemic has been on the insurance industry. But this has been one of the crux issues and coverages that seems to be gaining the most attention right now. So we're going to have to just wait and see. However, as far as the general liability policies go, those are the policies that business owners buy to protect themselves from bodily injury and property damage that their services or their products might cause third parties, customers, and others. What we're seeing in terms of COVID is that, and we haven't really seen too many of these yet, but a lot of companies, I've got a few clients that have done this, have pivoted and begun making products that battle COVID. So we're talking sanitization techniques, we're talking sanitizers, hand sanitizers, personal protective equipment, all those kinds of things. And obviously, it's possible that if they don't work as well as the customers expect them to, we could see claims arising from a product liability standpoint. Also, we see governmental agencies have been taking the lead in cases and suing businesses. In the New York, the New York Attorney General sued Amazon last year for failing to provide a safe workplace in 2 of their warehouses where COVID infections occurred. Of course, Amazon is hoping to get those cases dismissed. They also, the state of New York, sued Amazon again for a couple of areas where employees apparently were whistleblowing on Amazon and indicating they had unsafe workplaces, and Amazon is facing those lawsuits. So, and those were initiated by the, of course, the state of New York. So what's interesting is, as you may recall, in the middle of last year, before the election, there were some things called the liability shield laws, which became popular, and a lot of states implemented liability shield laws to protect primarily, initially at least, healthcare industry and first responders against claims, liability claims from their patients. And so those liability shield laws, they're not in all states, but most states have adopted some type of laws in that regard, and those have discouraged a lot of lawsuits, at least in the general liability arena. So there are still some areas which business owners need to be aware of. They still do have some liability areas. One of those is, of course, negligence or wrongful death due to products. Another might be the Family First Corona Response Act. That was a federal act passed in with the purpose of allowing employees to take paid leave for COVID-related necessities such as childcare, daycare, and those types of things. If an employer denies those employees the right to take those that paid leave, then that could generate claims against the business. Also, discriminatory layoffs could be another area. We're seeing now more businesses, and even some UNM even announced this last week, where mandatory vaccines are going to be required if employees are going to be allowed back to work. And those policies have been in place around the country sporadically, and we've seen that they have generated lawsuits by employees who feel like they're being discriminated against. So we're going to see a rise of discrimination claims as more employers begin deciding to mandate vaccines among their employees. And then, of course, whistleblower and retaliation lawsuits like the ones that I just mentioned on Amazon. So we're seeing that in terms of businesses and suing insurance carriers. Again, I mentioned, the fact that those lawsuits are in process. And again, a lot of those cases are becoming, they're more favorable in state courts than they are in federal courts. But right now, state courts are really awarding in favor of the plaintiffs about 33% of the time. And federal courts are only basically awarding in favor of the plaintiffs or the business owners about 4% of the time. So clearly the insurance carriers want those lawsuits to be handled in the federal courts. So moving on to the next slide, we can talk about workers' compensation and how COVID has impacted workers' compensation. Obviously, Paul mentioned correctly that insurance carriers saw a dramatic reduction in premium because workers' comp law premiums are based on payroll times a certain rate, depending on what the type of, what the duties of the employee are. So premiums have come down, and the question that a lot of my clients have asked is, well, are my employees covered if they, acquire COVID and come down with COVID on the workplace? One of the typical response is that a workers' comp policies would cover generally work-related injuries. That's what it's designed to do, but it's complicated because most community spread illnesses are not considered work-related or directly tied to the workplace. So those kinds of claims have typically never been made. If you get the flu, you don't really make a workers' compensation claim to your employer. However, that changed when COVID arose. So a lot of states have put in laws that automatically include COVID-related cases as a compensable claim. Again, carriers are making sure that those, as best they can, that those claims, that those the employees actually did become ill on the job with COVID, and that's a little kind of a high bar to overcome sometimes. But so the short answer is yes, they're covered, but can you really prove it? Impact on workers' comp costs. Again, we're not seeing that many claims actually being approved because it's really hard to see those claims are related to COVID at the workplace. There have been additional regulations passed that to protect the employers and lower their workers' comp costs if they are impacted by COVID. So we're seeing that, for example, in June of last year, New Mexico, along with 22 other states, agreed to exclude any COVID-related losses from their experience mod calculation, and that's a factor that actually goes into the premium computation based on losses. So employers not going to be penalized by having any COVID losses on their record. Also, from a payroll standpoint, workers' compensation companies have agreed, so they have, to address the payroll issue, because obviously a lot of employees were at home. Some were at home not working and receiving PPP payroll, and so they were getting paid to not work because the businesses were closed. And so obviously the workers' comp industry said, well, we're not going to charge you comp premium for those employees that are getting paid, but they're not working. Then we have employees who are getting paid and they are working, but they're working at home and doing different duties. So they created separate categories with lower rates for employees that are working at home. And they also eliminated they stretched out audit periods, and then payments were requirements were modified so that cancellation notices were not going out for many, many months, given the fact that businesses didn't have the money to pay for the premium. So there were a lot of things that the insurance companies were doing to try to make it a little easier on business owners. There's a little video here, or an image on the slide that shows a gal working from home and tripping over her dog. Actually that did occur in probably more than once, but that did occur a while back, and it was a compensable claim. So now that employees are working from home, sometimes there may be, either depending on what they did, there could be more or less exposures on at their home, and the workers' comp is going to respond if they are working and injured at home. So that's kind of in a summary, in a nutshell, what's going on with workers' compensation. Also, there's multi-state issues. What we're seeing, and I've even talked to neighbors where people now are working remotely where they used to work at the company headquarters. Now they're working from home, and a lot of times these homes may be out of state. Employees are moving all around the country and working from home. Because workers' compensation benefits are based on a state-by-state level, and most benefits are different from state to state. Policies need to be modified to make sure that if your employee now is working out of state and in a different location than the headquarters, and they're injured, then those benefits are going to be accurate. So all those things have kind of impacted workers' compensation. And so next is kind of automobile insurance. That's another line of insurance, which would be the next slide. And in terms of how COVID impacted that, Paul did a good job of kind of summarizing that in his opening. We are seeing, fewer accidents, but the accidents that are occurring are a lot more severe because everybody seems to be driving more rapidly. So I kind of like that, mainly because it takes me less time to get places. But it also seems like there's more road rage on the roads. So it'll be interesting to see how that all plays out. Also, insurance carriers are using telematics more. You can see that on a lot of these ads by Allstate or Progressive, where they're going to give you a little fob and you can plug it into your car, and they're going to monitor your driving, and your rates will be determined based on how well you drive, how slow you drive, all those kinds of things. We're also seeing on the commercial business side, relating to auto coverage, we're seeing a lot of driver shortages. So a lot of CDL drivers are unavailable. A lot of companies, a lot of drivers have decided to retire. The older drivers, the newer drivers aren't as experienced. Companies can't seem to find drivers. You're seeing a lot of that in terms of not being able to get supplies, whether it be construction materials or others. A lot of it's due to just drivers are not available to transport a lot of the stuff around the country. But that also makes it, a little less safe when you're driving by a big rig. So you might want to just kind of be a little more careful or cautious when you're out on the roads. So just as a little bit of New Mexico trivia, in New Mexico, with all those auto rebates, carriers were encouraged strongly, I think, to provide a rebate to insureds. And in New Mexico, a total of, I think over, let me see, I have a national number, over $14 billion was returned to auto policyholders throughout the country. In New Mexico, over $67 million was returned to policyholders in New Mexico. About 60 million of that was to individual personal policyholders. And then the rest of it was to business commercial auto policyholders. So costs definitely went down. The next coverage that I just wanted to mention was directors and officers employment liability, commonly called management liability. This area of insurance is really designed to protect business owners and boards for the kind of management decisions they make, and it protects them if they're sued, if people are harmed from their decisions. What we're seeing is an uptick in claims from publicly traded companies that their shareholders are coming back and suing the directors and officers, indicating that either they did not respond to post-pandemic reopening processes properly, quickly enough to keep their profits high and their stock prices up. We're also seeing, of course, in that employment practice liability area, a lot of claims, as I mentioned, anti-discrimination claims, anti-vaccination, claims are coming up in that area as well. So we're seeing this is an interesting area of insurance. It's become very difficult to maintain the premium levels on this. Underwriters are looking for great increases. Companies that don't have this coverage in place already may not be able to obtain it. Companies that have had high limits may not be able to get the same limits that they used to have. So we're seeing a lot of movement in this particular part of the insurance industry right now. what we're also seeing is a lot of multinational companies that work in multiple countries and different jurisdictions. They may have had those, we talked about those liability shield laws. Well, they may have certain liability limitations in one jurisdiction, which would be favorable for the business or the insurance company, but in another that they're operating in, they may have no protection whatsoever. So multinational companies are seeing, they're seeing claims to a higher degree than maybe companies that are just located in one more favorable legal state. Lastly, I just wanted to talk briefly about cyber liability coverage and how COVID has impacted that particular line of coverage. The fact that so many people have been working remotely definitely has increased exposures. And I'm sure Fiona can, she'll concur heartily with that. A lot of them are working on devices that either their own personal devices or their devices that have not been hardened and don't have the same kind of security that the devices desktops did in the company's home office. So we're seeing a lot of hacks successfully occurring in that regard, or just workers are not quite as savvy in terms of being trained on privacy and security when they're working from home. So that has definitely increased the claims that have been coming through in the cyber liability coverage. Also, we're seeing an impact in business interruption coverage is part of the coverage that a cyber policy can provide. Unlike a property policy where direct physical loss is required to trigger the coverage, a covered hack or security breach is usually what triggers that coverage. But it's going to be a lot more difficult to understand and determine what a business interruption loss is in the middle of a pandemic when businesses' incomes have been fluctuating so wildly already. So instead of having a determined pattern of profitability and expense, now underwriters or claims adjusters, I should say, are having to deal with a lot of this uncertainty in terms of, well, what really was your business loss? And was it due to the attack? Was it due to cyber or COVID results, or just business conditions? And it also, lastly, in terms of impacting coverage and availability in the cyber liability space, that has become also much more difficult. We're seeing, cyber liability is a relatively new kind of coverage, and the rapid increase of cyber liability claims and ransomware attacks have caused a lot of insurance carriers massive amount of claims. They're repricing this coverage dramatically. I had last week, one of my underwriters, I was working with a client, and my underwriter basically sent me this email because my client's cyber liability coverage almost tripled in terms of the premium, and they did not have any losses. But my underwriter gave this explanation. He said, as you may be aware, ransomware claims have become an epidemic and carriers are experiencing massive losses relating to this. All of this is having an acute impact in the market, and underwriting requirements are literally changing day by day. The insurance company's position is to decline all new business submissions from companies that do not have multi-factor authentication, and they're taking drastic actions on renewals for clients that are missing this and have other critical ransomware controls missing. So, Fiona, you probably hear about that all the time. You guys do, but it's not just, it's not just a nice thing to have all of these proper controls in place. It's becoming mandatory if a company wants this kind of coverage. So bottom line, future considerations where we are, this isn't on the slide, Paul, but as we, as businesses try to answer and as society tries to answer, what is the right thing? We're being told, do the right thing and do it now. Well, what is the right thing? Well, the right thing that business owners can do right now is really just be a little bit more forward thinking, understanding that the insurance market as a whole is getting hit by COVID in a lot of different ways. It's going to be to their benefit to become a better, more desirable company from an underwriting standpoint. What that means is, just going out and having their agents shop insurance and try to get the best price is really not an effective strategy anymore to reduce insurance costs. They want to look at risks. I know we've talked about this before, but a business owner really needs to be looking at what they're doing, lowering their risks. That needs to be communicated to the underwriters. It needs to be done outside of that renewal cycle. They need to give the renewal process more time. The underwriters are all still, to a great extent, working remotely, as are the loss control inspectors. So a lot of these renewal processes are taking a lot longer. Also, underwriters have lost a lot of their autonomy. A lot of these insurance companies have gone to big data metrics. They're using underwriting models, and so they just plug the information in, and the business owners' rates could get lumped into, the regional rates, which could be going up dramatically. And we have a lot less ability to have the local underwriter override some of those data metrics. So again, having a better risk management program in place is becoming really critical. Also, they just expect prices to continue to rise in the insurance sector. We're seeing even auto rates, even though yes, the auto carriers gave all these rebates back. The commercial auto space, underwriters are continuing to lose money, and we're seeing those rates increase along with all others. So it just take more time and do a better job of presenting yourself as a business to the underwriter. So that's really the extent of my information. I tried to kind of run through it a little quickly, but with that's all I've got to say about that. I don't know if there's anybody that has questions for John or Paul or I, but we'd be happy to.
Was John going to speak to any of these things, or should I?
Oh, well, John, you want to? I know you mentioned that. I know you mentioned that in
pretty much what I was going to cover, and I did in the beginning.
Yeah, I know you mentioned COBRA and those kinds of things. So
yeah,
probably it was just. So I don't think so, unless there's any other more specific questions related to those items.
Well, I have a COBRA observation,
Sure.
which gives at the micro level an example of what can happen. An immunocompromised employee was advised by his doctor not to go to work because of the risk of contracting COVID. The employer said, yep, makes sense to us. And so he went on COBRA. And as John pointed out earlier, the employer was probably benefited because the federal government picked up some or all of that COBRA cost. However, COBRA isn't viewed by Medicare as creditable coverage. He'd not signed up for Medicare Part B, and so he was incurring a Part B penalty. He was not able to enroll in a Medicare plan immediately. He's going to wait till COBRA runs out because his drug copays were $0 on the COBRA policy. I'm going to put him on a marketplace policy where it would cost him about $20,000 a year. And because he has Medicare Part A, because he's worked, I'll put him on a Medicare prescription drug plan where his cost is only going to be $10,000 a year, plus the Part B penalty, plus the Part D penalty. It just is a bad situation, which he had no idea was going to confront him when he took the strategy that made sense at the time.
Well, why did the employer terminate his coverage?
It didn't. He's at this point 16 months into the 18-month COBRA window.
Oh, I see.
COBRA's going to run out.
But I don't understand. Like, so he was working, he was immune compromised, and then he should have still been eligible for his group insurance coverage. Why did he not?
That is true.
Did he stop
That is
working
true.
and lose coverage through his employer? I mean,
And I can't.
so
I don't know the answer to that question, John.
so if you're 65 or over, like I am, and you're working for an employer and you have group insurance coverage, like I do, you get Part A of Medicare when you are 65, and that's free. And then you can work and be eligible for your employer's coverage, group insurance coverage, until you decide to retire or you lose your job or whatever happens. But at that point, then you can sign up for Part B, and you won't have to pay any penalty for your late enrollment in Part B because you were eligible for group coverage. So I know this is like not helping because he's already lost his coverage. But I don't understand like what prompted that to happen in the first place. He probably should have still remained on his group coverage.
Yeah.
So yes, the employer will benefit if they've been paying his premiums for COBRA, and but those are unintended consequences of those penalties, I'm sure. I wouldn't have seen those coming. I'm not a Medicare expert, but
Well, neither was he, and neither was the employer, obviously, because this is a bad situation to put him in, and he's got to stay there. He can sign up for Part B, so he'll have to pay the premium, but not get the benefit of Medicare, particularly because he'll have to be on an Affordable Care Act plan through next July. Again, not happy.
he's eligible for both A and B of Medicare.
No, now he's eligible for A. He can't sign up for B until the general enrollment period next December,
Oh, I see. Okay.
or January rather. Too much detail, but he's screwed basically.
Steve, you had a question, Steve?
Yeah, would you expect to see significant bankruptcies in the insurance industry coming up?
No, I don't. One of the reasons why I say that is because the rebate of the premiums to employees, normally that happens every time an employer or an insurance company doesn't pay 80% of the revenue on medical expense. And in this case, as I mentioned earlier, there was concern, especially on the part of the regulators in the insurance industry and also insurance commissioners around the country, that if insurance companies were to give back the excess revenue that was collected this year, it would devastate the risk pools and the reserves of the health insurance industry. So they've encouraged them to give rebates in the form of as much as they can in the form of medical expense. And also they're allowing them to rebate over 3 years. So it's going to be a staggered rebate. So it's not going to be a full 100% rebate this year. It's going to be staggered.
Okay, thanks.
Oh, and Steve, I can give you a property casualty answer, and that is maybe. Right now, this is just a bit of insurance trivia, but you always hear people saying, man, those darn insurance companies, they've got all the money. Well, they do have a lot of money. There's about $780 billion of reserves that the insurance companies as a whole have in the US. Well, essentially, they've got to maintain reserves is what they have to, by law, maintain to pay future and expected claims. So they have to stay fairly liquid. And then they also obviously use some of that to just pay their own expenses. The critical amount of reserves, they basically is about $450 billion. They say if the industry as a whole drops below that, then it would be at risk for being unable to perform. So right now, they've got that cushion, but again, based on how these courts rule, if businesses lost $400 billion a month in business interruption claims, and now the courts say you've got to pay all these claims that you never took premium for and never intended to pay, that could dramatically reduce that industry reserve really fast. So maybe it depends on what happens in the courts.
I would imagine that the industry would appeal that all the way up to the Supreme Court.
No question. I mean, yeah, and it's being fought on case-by-case basis. Individual restaurant associations are suing individual companies in various states. Sometimes they win, sometimes they don't. So it all depends on the state. But yeah, it's going to be interesting.
Okay, thanks. Thanks for a great presentation.
Thank you.
I'm just surprised nobody fall asleep. We did lose a few folks, but
I was 7 minutes ago, but it was very interesting.
well, thank you. Appreciate the opportunity.
Thanks
Thank you,
again.
everybody.
Excellent. Thank you. And before everyone gets off, I posted that document that Ed was mentioning in the chat if anyone wanted to download it before you jumped off the meeting.
Oh, thanks, Keith.
Yep.
Have a good week.
Thanks. You guys have a great day.
You too.